Welcome to the nuts and bolts of real estate. My name is Joe Bauer, and I'm here with my co-host Julie Clark. Julie, how you doing today?
I'm doing good, Joe. Just doing our thing, getting ready. We're going to find out this weekend. We're going to be figuring out all our high school stuff this weekend. So we're all on pins and needles. I'm trying to decide whether I'm going to send my kids to private high school or public high school. And, with all the craziness that happens these days at some of these schools and, lots of people are flocking to the private schools, but it is so freaking expensive. I don't know what to do. So we are on pins and needles this weekend trying to figure it out. A
Good
little
luck.
different than you on pins and needles waiting about the van.
Yeah.
But yeah, awesome stuff. Well, guess what, guys? Today we're going to have a big treat. We're going to jump into the multifamily stuff. I know that many of you, a lot of our friends here that listen to our show own a handful of rentals or 10 units, 15 units, that sort of thing, and interested on knowing how to get to the next level. So we are super excited today to introduce you to our new friend, Jennings Smith. Jennings is the CEO of My First Million in Multifamily. He's also the co-creator of the coaching and mentor program called the Deal Room, which he just got off of a mentorship call we're excited to hear about. And he's also host of Unlock Your Life podcast. We're going to get to know Jennings, but he started purchasing rental properties in 2013, moved into commercial real estate deals, and just in 2019 has grown his portfolio of apartment complexes and some self-storage and mobile home parks to over, I think, 1,500 units. He's going to let us know about that. So we're super psyched to learn more about My First Million in multifamily, his backstory. He's got a kick-ass Facebook community that's been growing like crazy with over 24,000 members. You guys are going to want to check out if you are interested in this topic today. So, hey, welcome, Jennings. How are you doing?
I'm doing great. Thanks for having me, Julie and Joe. I appreciate you guys having me on the show. It's going to be a lot of fun.
Yeah, it's gonna be a lot of fun. You were just commenting how you think that things are picking up, but before we jump into that, we'll kick it off with our normal, usual question to get to know you better. So go for it, Joe.
Yeah, Jennings, we love to hear about how you grew up, where you grew up, and how that led you into real estate. So as much or as little as you want to share, we'd love to know more about you.
Sure. Yeah, I was born in Nashville, Tennessee. And when I was, I think, 2, we moved to Indiana. And then when I was 6 or 7, we moved back to Summerville, South Carolina, which is right outside of Charleston. And that's where my dad is from, and his dad. We've been here forever. But yeah, I came back, and I showed an affinity for construction as a kid. I really liked to build things, put stuff together, and my dad sort of encouraged me in that arena. And so when I graduated high school, I did like a vocational thing in high school that had construction shop classes, that sort of stuff. And I got my builder's license at 19. I worked for a construction company for a year. I wasn't going to go to college. I was just going to get to work. And I did end up getting my license, but I said, Dad, this is crazy. I'm working 50, 60 hours a week. All my friends are at school. So I did end up going to college, went to Clemson for a business degree. And in the summer, I would come home and build rental homes for him. So he had a couple rental homes, and he was trying to build his portfolio up. And so he had bought a few lots, and he would get them cleared and prepped. And I mean, I would work for 90 days straight, 12, 14 hours a day, just framing these houses, siding them, roofing them, doing everything ourselves, except for, the mechanicals. And yeah, by the time I graduated college, I had built a couple houses, and I could show people what I could do. And that morphed into custom homes. And then, the recession hit. And so I go from making 100 grand or more a year right out of college. I'm thinking I'm on the top of the world and nobody can stop me, and I'm just this ultra successful entrepreneur, to the IRS 15 grand. My company had lost $50,000. I've got employees. I was living in a rental home because I bought my dream home that was this old historic house I was trying to renovate. So I'm paying mortgage, and I'm paying rent. And I would work all day literally and then go to Home Depot, and I'd grab those little brass peep sights, like those things that you put in your front door. And I could buy those for like $5. And I would knock doors with my drill and say, hey, do you want me to install a peep sight? I could do it right now for $20. And if I knocked on like 30 doors, I could sell 5. and I could make an extra $100 a day. And at the time, I needed it. And so it was just a super
Wow.
humbling experience to go from like, flying high to in the dirt. But it taught me, what I was made of. And it taught me that the metal in my backbone is there. Taught me that God is faithful. He's going to take care of me. He's going to bring me through that valley. And it also taught me that I need to have something besides construction, right? Because there's going to be good times in construction. There's going to be bad times. And I know a lot of people are in industries, realtors, mortgage brokers, contractors, like there's good times and there's hard times. And rental property can kind of smooth out some of those highs and lows. And so they're just like, man, if I ever get out of this, I'm going to get some rental homes like my dad has, and I'm going to make some serious progress towards that. And so that was kind of the catalyst that formed in my mind to say, I need something so that I'm never in this situation again. It was seared into my brain at that moment.
Good to learn it young. Heck yeah. Well, to keep going, because this is a good story. I mean, this is very relatable. Probably a lot of people are going, yep, me too. I know I've had that thing happen, and my rental properties have saved me. So I feel you there. I mean, that right there is motivation to try and get some of those to give you that extra cushion there. But keep telling us your story. So now you're after
Well,
your
so
people's, what's next?
yeah, the economy comes back. I'm moving to more renovations. I shifted from custom homes into remodeling, and diligence is always going to be rewarded. And if you're willing to work, then people will hire you. And we made it through that period. And I didn't get foreclosed on. I didn't lose my house. It was close, but it was okay. And as I got into the clear, I saved up about $5,000, and I started looking into mobile homes because my roommate in college, his dad owned a mobile home park. And I thought, well, that guy's smart. He's sitting in his trailer all day. He doesn't look like he's working too hard, and he's making money. Maybe I should talk to him. So I went to the trailer park. I sat down with him, said, how do I make money with rentals, with trailers? And he said, look, you can find trailers in trailer parks that are beat up. The person's not paying rent, and the park has repossessed this trailer. And you can go there, you can buy this trailer, and if you just start paying that trailer park lot rent, they're going to love you. And then you can rent that house out, or you can sell that house owner financed, and you can make some money that way. That's a good way to start with not a whole lot of money. So I saved up $5,000, and there was this old beat up double wide, didn't have any central heat and air. All the floors were ripped out. But I'm a contractor, right? So I go in there and I put an electric fireplace in there. I buy some window heaters, window air conditioners. I put the flooring down. I paint it myself. I fix everything up, and I sell it for like, I think $15,000 or $18,000 owner finance. So $2,000 down and maybe $600 or $700 a month. And I'm thinking, man, this is easy. I got it. And immediately that guy stops paying me. Like I didn't vet him at all. He had $2,000. I said, great, move in. And he didn't have a job. He had dogs. I mean, they were ripping this trailer apart. And so finally, after 3 or 4 months, I got him out. And I mean, the trailer's just destroyed again. Like all the work I had done, I'm back to zero. It was almost worse than when I first got it. And so I almost quit. It's like, this sucks. Like, I don't like real estate. This isn't for me. And coming to that recognition that you got to look at yourself. Like you don't know what you're doing. You didn't study it. You didn't hire a property management company. You didn't vet this guy out. You didn't do a background check. Like, this is on you, Jennings. And so I rolled up my sleeves, renovated it again, and I just sold it straight up. And I think I sold it for like 12 or 13 grand. And I ended up getting my money back. I didn't make any money, but I didn't lose anything. But I bought another one, and that already had a tenant in place, and for $7,000, and she was paying $700 a month. That was a cash flow good deal. I bought another one, and I kept saving money and doing this. And eventually I had 5 trailers and 2 rental homes. And to buy the rental homes, I had to save up $25,000, $30,000. And I'm looking at my goals, and I'm looking at the cash flow, and I'm just like, this is going to take me forever. And if you've been in real estate long enough and you own single family rental homes, you realize, like, if I'm going to make $10,000, $15,000, $20,000 a month in passive cash flow, like, I've got to have hundreds and hundreds of rental homes. Like that's just the reality of this. Or I got to do Airbnb or whatever. And I didn't want to mess with all that. And so I go to some mentors and I'm like, listen, I want to have 1,000 units. And they said, well, don't do that with single family homes. Like that's going to be way too hard to scale. It's going to take you forever. And I'm looking at just the math. You know, people don't sit down and do the math of how much capital that takes, how long it takes, how you're going to find all those good deals, how you're going to find all those single family homes.
Right.
And so that's where I started to, he said, you got to do commercial. So I started looking at like, well, what do I feel safe with? And the safest thing I felt like was multifamily. You know, people got to have a place to live. And most of my multifamily is like $700 a month to $1,200 a month. Like that's a reasonable rate. And that's always going to be in demand. And so, and then I learned, wow, you can buy this stuff with no money down. You can do creative financing techniques. You can raise capital. You can do joint ventures. And these deals are big enough to make it worth it for the investor, right? So if an investor gives me $30,000 for a down payment on a house, I mean, that deal is so small, like there's really nothing left over for me. Whereas if you're doing a larger deal, there's a lot more that can be made, and you can also increase the value. So in single family, it's like whatever the neighbor's house is worth, that's what your house is worth. In apartments, if you raise rents $10 across 100 units, and you're getting an extra $1,000 a month, and you're adding $12,000 to the NOI, and it's at a 10 cap, well, that's $120,000. If it's at a 5 cap, that's $250,000 or $240,000 you just added to the value of that property by raising rents $10. And so when you start to see the power of commercial real estate and you look at like, what are the multi-millionaires doing? What are the billionaires doing? Like they're buying commercial real estate. They're buying multifamily, they're buying self-storage, they're buying, you know, commercial like retail and whatever they're comfortable with, but they're not messing around with a couple single family homes because there's no scale to it. So I think single family, I never tell people don't buy single family homes. If that's where you're at, do it, but you don't have to camp there for the rest of your life. There's better opportunities, and I believe multifamily can scale more if that's what you want to do.
So that's so awesome and so true, right? What's your advice to somebody? Like, what advice would you give to somebody that has 5 or 10 single family homes that is hearing what you're saying and going, man, this guy's talking my language. This is exactly what I've learned. And I understand it's, you know, they're hard to find great deals to scale up, and I feel like I'm on the slow route. I've proved myself I can understand rentals and all that stuff. So what do you tell somebody? Like, how do you start? What's the first step to go? Is it a mindset thing? Is it a networking with brokers things? I mean, you know, you're looking for value add deals or just a cash flowing deal that you can build out over time. What would you tell somebody?
So,
I mean, do they need to get their money in order first? Do you know what I mean?
Yeah,
like,
no, these are all questions that people have. And my thought is if you have a couple rental homes already, then you can do this, right? I don't say I can help everybody. My program is not for everybody. And I don't think everybody can do multifamily. I don't think everybody's cut out. I'm not out there, buy my course, you know, we can make you a millionaire in a year, no matter who you are, no matter what, we can overcome every objection. No. But if you're like a realtor, you're a wholesaler, you're a house flipper, you're a contractor, you've got a couple rental homes, you literally have all the tools that you need to buy as much multifamily as you want. You just have to shift your focus, right? Because you know what it takes to run a company. You know what it takes to buy a rental. You know what it takes to close a deal. You understand the mechanics of it. And not everybody can do that, right? There's people that are cut out that they're never going to own a rental home, and they shouldn't, right? They're just not cut out for that, or they're never going to run their own company. But basically buying apartment complexes is like buying a cash flowing business, and you're going to have to manage and operate that business. So if you're not willing to do that and you don't have what it takes to run a business, then you shouldn't be getting into this field. But if you are, like, let's say you already run your own small business or you have a couple rental homes, you have what it takes. You just have to shift the focus. And so there's the foundation, right? So foundation is underwriting. Like you have to understand, how do I analyze a deal and what's the structure of the deal? the terms, NOI, and you just got to understand the mechanics of basics. You can do that on YouTube. You can do that through many courses that are out there. And the foundation is vital. And you got to get that piece down so that you have confidence and you know what you're talking about. But then that alone is not going to close you a deal, because you need the 3 pillars on top of the foundation. Like, you got to have a deal, right? So you got to be able to find a deal, know where the deal is. You got to have the loan sponsor, right? So you got to be able to get a $5 million loan or $3 million loan or whatever it is. And then you got to have the money, the down payment. And so people think, well, I don't have $1 million. I can't buy an apartment. So maybe if one day I'll save up $1 million and I'll buy an apartment. And that day never comes and they never buy the apartment. But so you have to get those 3 pillars in place, but the basics is the foundation. So, that's where I started. That's where I would encourage people to start, is just see if this is something that you want to do, by starting to build a skill level of, how do I underwrite a deal, and what makes a good deal, what makes a bad deal. And when you start understanding that, and then you see, wow, I can build a network where I can find somebody to help me sponsor my loan, right? That's what I've built with the Deal Room, is a network of loan sponsors. I can raise capital. If I don't want to raise capital, I can partner with somebody else that will raise me capital, and they can bring capital to my deal, right? I can start building relationships with brokers, and I can start getting off-market deals. I can speak intelligently to these brokers because now I know how to underwrite. I have that basic skill set. I can give them feedback. I can see, how could I structure the deal where maybe it doesn't work to other people, but it works to me. And so once you have the foundation and those 3 pillars, it's only a function of time before you close a deal. And once you close one, you're talking like confidence level through the roof. And I see it over and over and over, where people close one deal and, 1-2 years later, they've got 200, 300, 500, 1,000 units. There's students they've got more real estate than I do now, because they've just been pushing it. And once they break through that barrier of that first deal, that's the hardest part.
Yeah, let's talk about breaking through the barrier of the first deal. How did you break through the barrier of the first deal? We'll just go from your own experience.
Yeah, I would tell people to start small. Everybody's out there saying, think big, go after that 100 unit, 500 unit. And I think that is, you got to do what you believe you can do. And if you've got a few rental homes, you own a business, like, think about an 8 unit, think about a 12 unit, 16 unit. Like, that's something that, maybe it's $1 million or less, something you can get your arms around. You probably know somebody that's got high net worth, or there's plenty of people that have the ability to qualify for $1 million loan. You're only going to have to raise $200,000 or $400,000. Maybe that seems like a lot, but that's only 2 or 3 people, that are believing your deal, and you're giving them a piece of equity. All of a sudden, that becomes really, really manageable. And so I started with a 12 unit. So I took a course, I studied. I didn't do anything for about 2 years because I wasn't plugged into a network, right? An accountability group that was pushing me along, but I had the basics of underwriting. And so I finally found a deal and underwrote it, and I saw the value. Like, I could add a utility bill back, and I could raise rents a little bit. It was out in the middle of nowhere. The guy who owned it really wasn't paying attention to it. He had a bad manager on it, and I saw the vision. And so it was $250,000 for a 12 unit. This was back in 2019, very like January, I closed it of 2019. And so I found the deal, and I pitched it to an investor, said, look, I need $90,000. Like, the seller's going to finance me 70% because he knows his financials are terrible. Banks aren't going to loan on this, but it's a good deal. Here's why, but I need a down payment. The investor said, no, I'm good. So I went to another one. No, I'm good. Went to another one. He gave me a shot. He said, well, what's the split? I said, I'm going to keep 60% of the deal. I'll give you 40% of the deal. So, well, why don't I get 60% and you get 40%? And right there, I had to push back a little bit and say, well, deals are very, very difficult to find, and this is a phenomenal deal. Money is everywhere, and that is true. The further you get into this, I'm not going to say it's easy to raise money, but there's a lot of money out there that needs you, that needs your deals, that needs to be put to work and make a return with a qualified operator. And so he was like, well, that's fine. 40% equity is fine. Because I told him, we're going to refinance this thing in 2 years. We'll get your money back. We're not going to tie it up forever. And you'll own 40% of the deal forever. It's like, okay, so he did the deal, we closed it, and I mean, I was on it. Like, I was driving up there. It was about 5 hours away from me, so I bought remote. I'm driving up there every couple of weeks. I hired a new management company, instituted the rubs, you know, very little turnover because we didn't really raise rents a ton, just 10, $15, and cleaned it up and got the NOI where we needed it to be. And now we're making distributions every quarter, and the investors super happy. And as I grew, I realized, hey, this thing doesn't really fit my portfolio. It's only a 12 unit, and we bought it for 250, and 18 months later we sold it for 410,000. So he got his money back in 18 months. He made 40% of 160,000, and I made 60% of 160,000. So I made almost six figures. He made like a 40 to 50% IRR on his money, and it was a great first deal. And that deal gave me the confidence to close a 19 unit, a 63 unit, a 208 unit, and I kept kind of building from there.
Do you feel like the first deal sometimes that people do has to be a little bit outside of, I mean, I guess it could be anything, it just depends on how you get a deal and how you find it. But do you find that people need to be open to taking that, I'll say, tertiary market deal? I don't know how to say it, like that secondary area deal that people may, do you need to take a risk on that sort of thing and just make sure you're getting the right deal? And maybe you get what I'm saying? Like,
yeah, I do. And I think sometimes apartment guys, either they're smarter than I am, or they just make it more complicated than they need to confuse people. Because it's like, if you need 40 pages and all this waterfall and IRR table to explain how you're buying it something for 180,000 a unit and you're renting it for 1,500, but it's a good deal. Like, I got my napkin, right? I'm writing on the napkin,
yeah.
and I'm like, that doesn't look good to me. I mean, I'm a country boy, but I mean, I've owned a couple rental homes, and that doesn't seem like a good deal to me. And so that's why I'm not buying in Austin, Texas. I'm buying in Williamston, North Carolina. I'm buying in Moncks Corner, South Carolina. I'm buying in Tulsa, Oklahoma, because I bought something in Tulsa, Oklahoma for 27,000 a unit. I had to put 15,000 a unit into it, but I'm all in for 42,000 a unit, but I'm renting it for $700. Like, I'm like, multiply that by 208 units. That's a good deal. And it just appraised for $1 million. We're all in for $8 million. Like,
Right.
those are the kind of deals that they make sense to me. And
I mean,
that's
the message being, don't overlook a deal. A good deal is a good deal, right? If you do your homework and your due diligence, you can go buy a deal. We're in Washington State here. Go buy your deal down in Longview.
yeah,
Go buy your deal down in wherever that is, as long as it pencils, and you might have less pressure from, people looking in the hotter markets, I guess is one idea on there. I want to jump back also into, education versus grit versus a networking group. You said accountability, like, you need to hang around people that want to do and go where you want to go. Those are also your partners. That's also maybe your easier money. Let's talk about that for a minute. For people out there who are like, I'm doing pretty good. I've been able to pick up these rental properties, and I'm not afraid to buy that 10 unit or something like that. But talk about the value of, being in a group where you can all support each other, and the difference between education versus grit, and which one you think it takes more of, or
yeah.
both.
So I'm hearing two questions there, education versus grit, and then partnerships or versus lone wolf. And I think the single family game, it is kind of a lone wolf game most of the time, right? The flippers, they're out there hunting, maybe they get a partner, but multifamily is a team sport. It really is difficult to get anywhere significant without partners. And I didn't go, what blew me up, like even the first deal, I had to have a partner for the money. But then I partnered with my cousin Yaden, and we were like, we're going to build this. And so that's when we poured gasoline on the fire, and we were raising capital for deals. We connected with a loan sponsor that could help us get, $2, $4, $6 million loans. And that would have taken me decades as a
What does
lone
that
wolf.
mean for those listening? You connected with a loan sponsor.
So, for example, the first big deal I did was about $5 million. It was 63 units in Goose Creek, which is outside of Charleston. And to get that loan, you have to have a net worth of $5 million. Okay, I didn't have that. And you have to have liquidity of like cash in the bank of 500 grand, 10% of the loan. Plus, you have to have the down payment. Plus, you have to have real estate experience. So I had a little bit of real estate experience. I definitely didn't have the net worth, and I definitely didn't have the liquidity. And so the bank's going to look at me and say, hey, we love you, buddy, but we're not giving you this loan. And that's just the way it is. And so but it's not like your single family home trying to get that loan. If you're denied, you're denied. This is like, well, you can't qualify, but if you've got, Goliath on your team over here, this guy, he's good as gold. So if he's on the loan, then we're comfortable. And you can group liquidity, you can group net worth, and you can qualify for these loans as a collective. So that's what I mean with a loan sponsor. And to get a loan sponsor, you have to have a relationship, right? Because they're taking a risk on you. Like they're signing the debt that you're going to do what you say, that you're not going to get them in trouble and their credit in trouble. And so they have to be confident that you're doing what you say. And that's where I tell people, start small, right? Start with a smaller unit, build your track record. You don't necessarily need to go jump into a $10 million deal for your first deal, because if you do that, you may be a minority partner, right? The loan sponsor may be taking over. They may have their asset manager in place. Maybe, hey man, thanks for finding the deal. You can raise a little bit of money, but we're not letting you drive this ship, right?
Right. It's almost, you're not getting what you want anyway. Yeah.
Right. You're 15, you just got your learner's permit. You're not driving the Lamborghini. You're going to drive, the old pickup truck. Okay. So, and they should, right? Because you don't know what you don't know. And so that's why I also encourage people to start with something that they're going to get their arms around and feel confident with. But yeah, that's the loan sponsor. And to really scale, you need capital. And every time you buy a deal, most single family guys and girls, I mean, they're plowing everything they've got into the next deal. And this is why they don't have any money to fix the water heater or replace the roof or whatever, because they're constantly broke. They're constantly investing. And I don't take that. Like I keep money in the bank, right? Because I want to have money for when something goes wrong with one of my deals, and I got to input cash, right? I want to have a liquidity buffer there, and I can raise money and I can continue to scale versus, okay, I just plunked down 300 grand. That was really all I had. Now I've got to wait another year or two until I refinance something else before I can buy anything else. And so you're kind of stopped dead in your tracks and you cannot scale. But if you raise capital, dude, there's more money than you would ever need out there.
Right.
If you can connect with it.
You need some experience. So start at that 12 unit or whatever, and then get that under your belt. So you have a little track record plus your rental houses that you already have, and then go start connecting with the groups and meeting the people to raise that capital, or do it all at the same time. If that's your personality, I guess I'll say, what's a good deal structure that people can, when they're partnering with these sponsors or what is the realistic expectation of, and is there anything that needs to be protected in regards to control, with 5149 or, who's, doing what, right? I mean, what would be somebody's first deal or two good structure, or is it just whatever your money sponsor is willing to do without you being stupid and giving your whole deal away? Sometimes getting less money in that experience is going to be what counts also towards if you're looking to move up in the ranks and start getting bigger sponsors and doing bigger deals. Is it fair to say you might take less on a deal just to get that under your belt, or what are your advice there?
Yeah, I think that you got to be realistic, and the person that is putting the capital in, it has to be worth their while. It's got to be a devastatingly attractive offer, for them to go for it. And so that being said, I see a lot of people work really, really, really hard for very, very, very little. And when those incentives aren't aligned, it can cause trouble for the money guy, because the guy that's doing all the work, he owns 3% of this deal and he's killing himself. He may be like, you know what, it's just not worth it. And
Yeah.
so I think it's got to be equitable. So there's a couple ways to structure it. You've got, there's tons of ways to structure it, but the basic ways are, a straight up split. So I get 50%, you get 50%. I get 70%, you get 30%, whatever. That's just a straight up split. There's another way to do it with the preferred return and then the split. So a preferred return would be, if you give me $100,000 towards this deal and the preferred return is 5%, the first $5,000 that comes out of this deal goes to you, right? It's like 5% interest on your money. It's not interest, but it's a preferred return. And then we split the deal 70-30, 70 to you, 30 to me, whatever it is. And so the preferred return, investors love it, right? And the higher it is, 7, 8, 10%, like the more their money's protected, right? Because the syndicator, he doesn't get paid until he pays that preferred return. But as a syndicator, you got to realize you may be working for free. And this has happened to me. I did a deal, like this is one of my failures. And I have a podcast, I'll like Google $6.1 million deal gone bad. And I bought a 70-unit apartment complex in Clemson, South Carolina, and it went bad. We didn't do well with it. Some things with the market went against us, and we made some mistakes, and we pulled it out of the fire. We got all the money back out, and we made, I think, like 5 or 6% net return, but the pref was 10%. So all the money went to the investors, and we worked for almost 2 years, took on all the risks, signed the debt, did all for nothing, zero. So, that's okay. It's part of the game. And I was super grateful to return all that capital and keep my promises to my investor base. But when you have that preferred return, you got to realize that you may be working for free, and that preferred return is going to suck up all the cash flow because you got to pay that first. You can't be paying yourself distributions while you owe the investors that preferred return. So I would recommend to keep it simple, just do a straight up split on your first couple deals. That way you're getting cash flow, they're getting cash flow, you're building that passive income, and you're building that runway so that you can spend more time on doing this and grow it more versus, well, I'm going to be rich in 2 or 3 years once I refinance this and get this preferred return off my back, which is how I did a lot of my deals. But if you do have heavier preferred return, you can take more equity as a syndicator. So there is just kind of a balance of how you want to structure it.
Awesome. And so, yeah, again, this is all good stuff, guys. And where are people? Let's talk about because we're going to get in longer in the time here, and I want to make sure we mention this. Tell us about what the deal room is, or what that's all about, and what you do with your mentorship program there.
Yeah, I kind of just look at my own journey and what I had, what worked and what didn't work. And so I built this Facebook group to really to raise capital and to find deal flow. And it morphed into people asking like, can you teach us this stuff? Can you train us, et cetera? And so we built a course, and it was $2,000 to buy this course. And a lot of people bought it. And they didn't really get that good of results. I'll be honest. Like the information is sound, and you need that information. But like I said, it's like building like laying a foundation and walking away and being like, oh, the house is done. Like it's not. Like you got to have the foundation, but that's not going to put money in your pocket. That's not going to close deals. And so they asked for ongoing mentoring and really behavior modification. And when I think back about me taking the course, I'm in a silo, I'm watching these videos, I don't fully understand everything, I don't have something to bounce ideas off of, I'm trying to make big financial decisions without a mentor, and it paralyzed me for a really long time. So what we did was we formed the deal room, and it's basically 4 components. Now we give you the course, we cover the cost of the course. If you join the deal room, we just give it to you so that you have that foundation with education. And then secondly, we do, the mentoring, the networking, where we do calls where we underwrite your deals live with you. We see, hey, this is a good deal, this isn't a bad deal. We have a call where we train you on how to underwrite, how to get better at those building blocks and basics. And then we plugged our network in, like our loan sponsors, like my network of multimillionaire people that are interested in real estate that want to do deals, our investor base, our capital raiser base. And then we have conferences and we have Zoom calls and we have networking and people seeing who's doing deals, and those partnerships are forming where somebody's got a deal, but they need money. Somebody's got money, but they need a deal. Somebody's got both, but they need a sponsor. And these partnerships get forged, and it's cool, man. I mean, every week deals are coming out of the deal room on a regular basis because we modified that behavior, putting them into deal sprints, holding them accountable to get the things done. Like, I need to call 10 brokers this week. I need to put my pitch deck together and talk to 4 investors. And so we meet with them weekly. They lay out publicly what their goal is with their sprint team. And then we meet with them the next week and meet with them the next week, and we hold them accountable. And when we modified behavior, held them accountable, and gave them a network, that's when our students got results. It wasn't from the course. They needed the course, but it's just not enough.
So let me ask you, so if there's people on here that are like, you know what, I don't have the time to go hunt down all the deals and do all that stuff, but I do have some money. Is the deal room like a balance? I mean, you probably have more people hunting for the deals and all that stuff, but do you invite people into the deal room that, let's say somebody here is listening and they've got 500 grand to deploy or something like that? Can they join the deal room and be on that other side of, hey, I'm you know?
We have people join the deal room for the sole reason of finding deals on the cutting edge, right? They want to get educated. Because think about this. If you're an LP, a limited partner investing in syndications, and you don't understand underwriting and you don't know what a good deal is, like, the chances of you losing are high. I mean, there's a lot of real estate deals out there that get pushed out at 20-something% plus IRR. These are going to be great. And they're not. I mean, it was easy to make money in real estate the last little bit, and the tide is going out, and you're seeing who's real and who isn't. And so I think it's extremely important to protect yourself and educate yourself on how do I personally analyze the deal, and then get connected to the networks where you can see, hey, this guy was just on the underwriting call. He's got a 34 unit in Ohio. He's got under contract for $40,000 a door. Everything's rented at $650, and we can get $750, $800 a month. And you need 600 grand. You know what? I think I'm going to reach out to that guy, which is what happened to me. And I partnered with the dude, and we took the deal down because I was in Ohio, and I was like, let me run by there and check that out, because those numbers look really, really good. And it was a really, really good deal. And so I got him his down payment, and I sponsored his loan, and we closed the deal together. And yeah, there are people that are in the deal room just to get access to that first cutting edge of the deals, for sure. Not everybody's using it for that, but there's, I would say, at least 10 or 15 people that have joined just to find off-market deals.
That is awesome. I love it. Sounds like a great community. I mean, like, so did you say it's free for people to join your deal room, or they pay to join? How do they
join
the room?
Yeah, my first million in multifamily is our large group, and we give a lot of value there. That's free. That's a good place to start. If you're like, I don't need that, I want to actually close deals. The deal room is application only. You can go to getinthedealroom.com. It's $400 a month. There's no commitment. And
Joe's going to be dropping all this stuff in the info below, guys, where you'll get all this.
But yeah, if you go to getinthedealroom.com, it's a video that walks you through how you can make $10,000 a month in passive income off of one deal. And then you can book a call. Me or Yaden, my partner, will jump on a call with you. We'll be like, where are you at? And if you're like, I got no real estate experience, I've never owned a rental home, I've never owned a business, I've never kind of done anything entrepreneurial, you're not going to be approved. Like, we're not letting you in the deal room because we don't know for sure that we can help you. But if you're like, hey, I'm a contractor, I'm a realtor, I'm a wholesaler, I'm a house flipper, I've got a couple rentals, or I wish I had a couple rentals, but everything I've flipped, I sold it, but I know this business and I like it. Like, we can help you, and I can commit to you that I can help you. But so there definitely isn't like everybody's invited, we'll take your money. I only want to take money from people that I know that within 6 months, they're going to be closing a deal. So that's sort of my parameter. Is I can see from the previous data, like the metrics, who closes deals, and I know who my avatar is. So if you're my avatar, then I'd love to talk to you. If you're not, then it's probably not going to work for you.
That's good stuff. I want to touch on just one more thing before we're wrapping up, while people are working on themselves outside of the group and thinking about these things. How important is it in multifamily to start making relationships with brokers? And if you're starting to get because I know brokers control more of the multifamily, the bigger commercial size deals, is much more broker involved than some of these. Maybe I'm wrong. Maybe I'm speaking wrong. You'll know better than me. But how do you advise people who are at that middle ground? They've got their 5 or 10 single families. Maybe they have a duplex or here and there, and they need to start looking for bigger deals. Is that through networking with brokers? And how do you what is the talking point of somebody reaching out to a broker when they're not
Yeah,
in the A game yet?
brokers are awesome. And I think that I've gotten about half of my portfolio from brokers. And if you can build a relationship with them, they will bring you deals before they list them. They'll bring you deals before they tell anybody else about them. They'll bring you deals when they're just talking to the owner who's maybe interested in selling. And that's a really unique place to be, because a lot of times the deals that you see circulated, they've already taken them to their top 10 guys, and those guys didn't want it, right? Or they tried to make an offer that worked and it didn't happen. And so those relationships can be very lucrative. So you can also burn them up quickly. And if you call a broker and you don't know what you're talking about, you have no idea how to underwrite, you don't speak the language of commercial real estate, it can almost do you more harm than good. And so my caution is, if you're going to do this, if you're going to just like cold call brokers and like cold call them in a market that you don't want to be in, like shake the rust off there, and then when you get a little bit more confident, talk to the brokers in your market or the markets that you want to be in. But there is no substitute for putting in the work and building the skills of, I'm going to know this industry. I'm going to become an expert in it. I'm going to know the language. I'm going to know the underwriting. When brokers send me stuff, I'm going to be able to analyze it and give them feedback on what I think. And they're going to see, hey, Julie knows what she's talking about. This deal didn't work for her, but like, she's a player. Let me see what else I got in my pipeline. And so it's really not hard, but I see that people, they want to put the cart before the horse and not talk. And then the flip side is they get paralyzed and they study too much and they never call brokers. That doesn't work either. You got to hit that balance.
Absolutely. When you're looking at the deals and you're underwriting in your deal room with your people that you guys, I know there's some experience. Is there something, and this will be the last question, then we're going to wrap it up and let everybody get back to the grind here. But do you feel like there is a common thread? Like usually when there's underwriting, people miss this, or they don't underwrite the expenses high enough, for example, or they use the wrong, cap rate, or too aggressive on that? Or where do you see underwriting kind of common denominator mishaps?
I mean, a lot of it matters, right? So, but location. Some of the first things I'm looking at are, is this a growing market? Is this a good area? I think that this is something that's a little different than single family, is the in-place cash flow. They underestimate how difficult and how long it'll take to fill that property up, right? So if you buy a vacant rental home, and whatever, that's done all the time. It doesn't really affect the value. If you buy a 50% vacant apartment, I mean, that is a huge risk, because you're talking dozens or more people that you've got to fill it up, and you're just bleeding cash the whole time you get there. And if you can't make the turn, you lose the building. And so I think that people underestimate that. Like, really look at the occupancy and vet those numbers, like see the cash deposits, see the sign estoppels from the prior owner guaranteeing that that's what they're collecting, and you're seeing the deposit tickets, and you're verifying it with the third party management. Like, I think that's very important. And I think that moving from there is like rents. I mean, you go on a spreadsheet, rents are at $700. Yeah, we can get $900. Well, can you get $900? Why do you think that? How do you go about vetting that number out and making sure, which is, there's websites and you can talk to property managers. And then, yeah, you hit the nail on the head with the expenses. A lot of times expenses run in the 30s, 30 to 40% for single family. They're going to run higher for multifamily
Totally.
because you got water, sewer, you got a lot more overhead. It's not just PITI, you know, it's a lot. Replacement reserves, those roofs are going to go bad. Pipes are going to bust. You know, you've got to maintain the parking lots and you got to maintain the windows and everything else. And so 45 to 55% or higher is standard in multifamily, especially some of these like C-class 1960s, 70s stuff. Like it's just the copper's failing, you know, the air conditioners are breaking, the parking lots are going bad. All that stuff's got to be accounted for in your overall plan. So people really can miss on that too.
And the numbers coming over for the brokers are typically not the right expenses, I find, right? That the brokers seem to put their numbers out at a little bit tighter expenses. So just remember, you always got to do your due diligence on your own, right? In regards to,
Yeah.
right?
Yeah. Well, I mean, like when, you know, when you're going out on a date, you're putting your best foot forward. You're putting on the suit. You know, you're putting the makeup on. You're trying to look the best you can. It's
Right.
not like, you know, Saturday morning, waking up, you know, your breath stinks and all that, like marriage, right? So you just got to figure out what is the true story, right? Not just what the broker says or what you want to think. You know, you can have the rose-colored glasses on too. You can be enthralled and enamored with a deal, and you're trying to make these numbers work. You've got to see it as it is, and you've got to make offers that work, not well, we'll make it work no matter what, but we're gonna make this deal work. We're gonna buy this deal. Like that is a dangerous place to be.
Yeah. Yeah. How about bridge loans these days? How are you guys financing your purchase on? Are you guys buying value add, or are you doing, you're buying it cash flow and you're just turning the units over time? What's your story these days on the bridge loans in the environment that we're in?
You know, never say never, but I wouldn't be doing it right now. I had 3 bridge loans. Well, I mean, I've done quite a few, but I had 2 bridge loans that I exited last year because I was nervous, and we sold both properties. One was the one that we pretty much broke even on. The other one we made $1 million on it. It was really great, but it was a bridge loan and it was a very heavy value add deal.
You'd like to
We
buy,
have
do you prefer to just go straight with a permanent
yeah.
loan?
If you can get a local bank, if you're doing less than $5 million deals, most of the time you're a really good bet is just go to your local bank, credit union, get a 5-year fixed term, 25-year amortization loan. Maybe they'll give you 6 months, a year of interest only payments. That is a phenomenal thing. Like there's usually very little prepayment penalties, but these bridge loans, I mean, they're great and you can buy stuff where the DSCR isn't there, but you know,
Risk.
the
Yeah.
gun is at your head, you know,
Yeah.
and you can extend them and it's there's options there, but I like our very, very dangerous deal we did in Tulsa, which was half empty, huge renovation. We got a 5-year bank loan on it. We paid out the nose for it because we had to close quickly. We had to pay like 3 points at closing, but we refinanced that into Fannie Mae or Freddie Mac long-term debt, like a 10-year loan. And we did it in like 2.5 years, but we had another 2.5 years. So like
Right.
if we weren't done or
Didn't
something
do
had
it with the
happened,
pressure.
we
Yeah.
had time. Yeah, we had more
Right.
time. And
Absolutely.
in real estate, it's pretty much the only way people go bankrupt is they run out of time. And they get pressured into selling stuff, or they have to refinance, or they have to take a bad deal because they ran out of time. So I'm especially right now, get as much time as you can. 5-year, 7-year, 10-year loans are I wouldn't, because what if you get into a bridge debt and in 2 years, like the rates are higher, you know,
Right.
and even though you've done your job, can't refinance out of them. Well, if you're in a regular loan, then okay, just wait another 3-4 years and then you can sell it or refinance it. You're probably going to be okay. Sometime over the next 5 to 7 years, there's going to be an opportunity to refinance or sell versus, dude, 2 months in these big deals, it goes by in blink of an eye. It's fast.
Yeah. Yeah. Understood. What type of, last question, what do you put on your stabilized loan to value? Do you put on 70% or do you do lower on stabilized?
It kind of depends on the deal, but the last couple we've done like 65%. That's been enough to get all the investors cash out. And it's kind of a catch-22. The more cash you pull out, the more stress you put on the deal and the less cash flow you're going to get in the future. And so I like the 65, 70%. And most of the time where we're at right now, they're not going to give you much more than that anyways. They used to be 75%, used to be 80%. Back in 2017, 18, you could get 80% LTV on a refi, no problem. But now those kind of days are gone.
Yeah. Well, dang good stuff, guys. Super pleased to understand and know about the deal room. Where can everybody follow you? Again, my first million in multifamily. What's the best channel?
The best place to go is just my name, Jennings Smith Jr. JenningsSmithJr.com. You can join the free Facebook group there. You can listen to my podcast there. You can check out the deal room if you want to check that out there. Jennings Smith Jr. JenningsSmithJr.com.
Cool. Awesome. And what's your Unlock Your Life podcast about?
Unlock Your Life is it has a real estate leaning, but it's essentially for people that are stuck doing something that they don't want. I see a lot of people that they're working a job that they don't like, or they're even working their own business, right? It might be their own small business, their own prison that they've created, and they're not having the time freedom, they're not making the money, and they feel like they're on the hamster wheel. And this is a show about how to unlock your life, how to unlock that mindset, how to think bigger and give you opportunity and tools to take risks and to take those challenges, to take those leaps and equip you to do that.
Awesome stuff, brother. Well, good. This has been nice. I've enjoyed this. I like to say this has been very pleasant today. We enjoyed it very much. Yeah. Thanks are you attending any events this year or hosting any events this year where people can come meet you?
February 23rd to the 25th, we're hosting an event, our conference in Charleston. So my first million multifamily conference, February 23rd to the 25th. And very excited about that.
Hey guys, if you haven't been to Charleston, we were just talking, is beautiful there. Get you some of that barbecue and I went to Charleston, like I told you, Jennings, for spring break with my kids, I don't know, about 4 years ago. And I've never ordered barbecue since I got back to Seattle. I'm like, there's no point. Right? So good. So good. So, well, good stuff today, guys. And thanks, Jennings, once again. And Joe, where can everybody find the details of today's podcast?
Yeah, if you guys need to get to the links, they'll be down in the description below if you're watching this on YouTube, and you can get all the show notes at seattleinvestorsclub.com/178.
And hey guys, do us a favor. If you like our show here, subscribe, give us a like, hit whatever you're supposed to say on that sort of stuff. It helps us attract more attention and get cool people like Jennings wanting to be on our show. And of course, we want to bring you everything we can to add value to it. We work real hard on picking the right people. So give us a like I said, and let us know that we're on the right track. All right, everybody. Enjoy.
Julie and Joe, thank you very much. It was a lot of fun.
Awesome, Jennings. We'll catch you on the next one.
Okay.
See everybody.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.